Hey guys, welcome back to the channel, and today we are going to be breaking down the top 3 UK financial stocks to buy and hold forever. Now, just a quick reminder, this is not financial advice, it's for educational and entertainment only. Always do your own research and invest based on your personal circumstances. Investing involves risk, and past performance does not guarantee future results, and investing always means that there's a risk that you can lose money. And the first one that we are going to be looking at is HSBC. It's one of the world's largest banking groups. They operate across Hong Kong, the UK corporate and institutional banking, international wealth, and premier banking and corporate centre. Excuse for my voice. It's been an absolute sweltering of a weekend, and I am getting to the point of struggling with the weather. But they are just not just a UK bank. They are a global financial powerhouse with deep exposure to Asia, international trade, and wealth management. And as you can see, they've been pretty much steady long term. They're a good performer and benefiting from the rising global interest rates and strong Asian wealth growth. And as you can see, in the year, it's actually up by 55%. Year to date, it's actually up by 16%. 5 years, it's actually up by 209%. 10 years, 216%. And all time, it's actually up by 473%. As you can see, it does have a 4% dividend yield. HSBC is one of the most reliable income stocks in the UK market, especially with the earnings that are supported by the higher net interest margins, the strong Hong Kong and UK performance, cost cutting, wealth management growth, and the buybacks and capital returns. However, HSBC isn't just all one going up train. The stock does go up and down, and especially when HSBC's share price is driven mainly by the global macro events, not just the UK only news. The bank is heavily tied to Hong Kong and China, so when China announces stuff like cut rates or shows signs of economic recovery, HSBC usually rallies. Recently, the stock has been very volatile due to concerns around Hong Kong commercial real estate, shifted expectations for US Federal Reserve rate cuts, and geopolitical tensions between the US and China, because HSBC earns a huge portion of profits in Asia, so reacts more to Chinese economic data than anything happening in the UK. Now, of course, there's risks to the UK finance sector, like the global recession, the regulator tightening rules, credit defaults, currency volatility, and a lot more, like geopolitical tension at the top of my head. Now, of course, HSBC, like I say, has heavy exposure to Hong Kong, so that's the specific risk for that, and of course, the specific risk in Asia. Now, if we are looking into HSBC and what do we need to look out for, well, I would say the Asian economic growth, the dividend sustainability, especially at 4%. Are they doing buyback announcements? Are they doing good wealth management performance? That is what the stuff I would look out for, especially with HSBC. Now, if I was going to be added today to my portfolio, I would say that it's probably because for the global diversification, strong dividend, and exposure to Asian growth, but also because it's a unique blend of UK stability and international upside, and it's shown that even during the rough periods, it's actually been able to increase its share price. And then, of course, the next one, which you probably were expected, is Barclays. Barclays is a full-service bank operating across retail banking, corporate banking, and wealth management, and investment banking too. They also run Barclays UK Corporate Bank, Private Bank and Wealth, Investment Bank, and the US Consumer Bank. Now, of course, Barclays has been very volatile but resilient. Its investment banking arm drives earnings in strong markets, while retail banking provides stability. But as you can see, it's actually down by nearly 7% year to date. A year ago, it's actually up by 36%. 5 years ago, it's 147%. And 10 years, it's actually up by 161%. As you can see, the dividend sits around 1.9%, with potential for increases as profitability improves in Barclays. The earnings depend heavily, though, on the trading revenue, investment banking activity, the corporate lending from Barclays, and the US credit card performance. However, Barclays moves for a completely different reason for HSBC. It's very highly sensitive to investment banking cycles. When global markets are active, IPOs and M&As, deals, trading volumes, Barclays tends to outperform quite a bit. Now, recently the stock has risen on stronger than expected trading revenue and positive updates on its US credit card expansion. However, it can very fall quite sharply when markets quieten, when investment bankers' fees drop, or when the regulators tighten capital requirements. Now, Barclays is essentially a leveraged play on market activity and corporate deal making. Now, the specific risk for Barclays would be the high exposure to investment banking, in my opinion, and the sensitivity to global markets. Now, if that was me and I was looking out for the stock, it'd probably be for looking at the trading revenue, the cost cutting progress if they have any, return on equity targets, and investment bank performance, but also the key one, the US credit card growth. Now, I would consider Barclays for a diversified income streams, and that's probably why I would invite that into my portfolio. And its ability to outperform when markets are very strong. Now, it's a clinical stock which long-term upside when the investment banking environment is quite healthy. So for me, that would probably be an add to my portfolio. And lastly, is Lloyds. It's the UK's most domestic-focused bank. And that's probably everyone can remember it with the black or dark horse on every single sign and window of its bank. Now they operate through retail, commercial banking, insurance, pensions, investments, and other segments that is classed as other. Because otherwise, I'll just be going through this list all day. Now, they're very deeply tied, however, to the UK housing market, but also the everyday consumer banking. Now, Lloyds is a pure UK play. Its performance actually relies and falls with the British economy. Now, with a 3.6 yield, Lloyds is one of the most attractive income stocks in the UK. Earnings are driven by mortgage lending, consumer banking, insurance, higher interest rates, but also cost control. But this is the thing. Like HSBC and Barclays, Lloyds moves completely different because it's 100% tied into the UK economy. Now, recently the stock has been moving because of several key catalysts. Now, of course, the UK government is easing ring-fencing rules, reducing regulatory pressure and freeing up capital, which has boosted investor sentiment. They are also finally exploring new lending opportunities in the US tech infrastructure sector, which investors see as a growth driver. Strong AGM results and higher dividends. Lloyd passed all AGM resolutions and highlighted dividend strength, supporting the share price. They've also got the bullish technical structure, as the stock has been forming highs and higher lows, signaling strong momentum. However, Lloyds can fall when the UK mortgage approvals drop, when recession fears rise, or when regulator issues, like the ongoing car financial compensation scandal. Now, that for certain creates uncertainty. And Lloyds is essential a direct bet on the UK housing market and consumer confidence. So, like I said, the specific risk for Lloyds is probably the heavy UK exposure, limited international diversification, the sensitivity to housing market, and liabilities like the car finance. But if that was me and I was looking out for the stock, it'd probably be looking at how the mortgage growth is doing, loan loss provisions, dividend coverage, and of course the UK economic data. Now, I would consider Lloyds for the portfolio as it's got a strong dividend dominant UK position and exposure to housing market. If you believe in the long-term UK recovery, Lloyds is probably one of your strongest long-term holds. So those are my top 3 UK financial stocks to buy and hold forever. So HSBC, Barclays and Lloyds. Each one offers very much something different if you're going to add all 3 to your portfolio. Now, of course, HSBC gives you global exposure. Barclays gives you investment banking upside, and Lloyds give you UK-focused stability and dividends. Now, of course, if this video hits 10 likes, I'll create another one of one of these top 3 sectors, and we'll do a different sector each time. But if you do like it, leave a like, hit the subscribe button, and I'll see you on the next one. Goodbye.